$37.6 trillion in US debt. Inflation still above the Fed's 2% target, interest costs moving toward $1 trillion a year. And yet most investors are still positioned for the ending they got used to in 2008 and 2020. Something breaks, the Fed cuts, liquidity returns, markets recover. But what if that playbook is breaking? Ray Dalio has been warning about this for years, and now the underlying conditions are starting to look a lot more real. Because the next major repricing may not come from a single shock. It may come from a much more dangerous combination: sticky inflation, slowing growth, rising debt, and a central bank that has less room to rescue the system than markets still assume. That is the trap. This is not a hyperinflation story. It is not a dollar collapse story. It is something narrower and in many ways more serious. The margin for policy error is shrinking, and when that happens, markets do not just react to headlines. They begin repricing the mechanism underneath the headlines. That is the part most commentary still misses. The surface story says inflation has come down a lot, and that is true, but headline PCE is still running around 2.8% year over year. The Fed's target is 2%. That gap may sound small, but in policy terms it matters. Inflation is low enough to make people feel comfortable, but still high enough to constrain aggressive easing. Now put that next to the fiscal picture. US federal debt is roughly $37.6 trillion. Deficits remain large. Annual interest expense is approaching $1 trillion. So this is not just an inflation problem, and it is not just a debt problem. It is both at the same time. And that is where the old market assumptions start to break down. Because if growth slows from here, the Fed should normally be able to cut hard and stabilize the system. That is what investors have been trained to expect. But if inflation stays stuck near 3%, aggressive rate cuts risk reigniting the very problem the Fed has spent years trying to contain. So the central bank gets trapped. Cut too much, and inflation can reaccelerate. Stay tight too long, and debt service rises, growth weakens further, and financial stress starts building somewhere else in the system. This is not fear. This is arithmetic. And once markets start to understand that the rescue function is weaker than it used to be, the repricing does not stay contained to one asset class. Stocks have to adjust to a world with less policy support. Bonds have to absorb heavier fiscal pressure. Credit becomes more fragile because refinancing risk starts to matter more. And if leverage is high enough in the system, what begins as a rational repricing can turn into forced selling. That is when the story changes, because forced selling does not ask what is valuable. It asks what can be sold. And that is why the next market decline may not begin with one obvious crisis headline. It may begin quietly, a slow repricing, some weakness in risk assets, a little more stress in credit, a little more volatility in rates, and then suddenly the whole process accelerates because leverage, liquidity, and confidence collide at the same time. What looks irrational in those moments often makes perfect sense once you follow the balance sheet. Now bring that down from the system level to the personal level. Cash still feels safe because the number in the account does not move much. It looks stable, it feels stable, but if inflation remains above what your savings earn after tax, then your purchasing power is still eroding in the background. That is what modern currency debasement usually looks like. Not panic, not an overnight reset, not a dramatic announcement, just money that appears stable in nominal terms while becoming weaker in real terms year after year. And that is why this stops being just a policy story and becomes a portfolio story. Because if cash quietly loses purchasing power, bonds face growing fiscal pressure, and the Fed has less room to cut than markets expect, then investors start looking harder at assets outside the promise-based financial system. That is where gold enters the picture. Not because gold is perfect, it is not. Not because it pays income, it does not. And not because it is the only answer. Some investors will prefer T-bills, short duration, commodities, energy, miners, or selective defensive equities. But gold matters for one very specific reason. It carries no issuer liability. It is not someone else's promise to pay. It is not directly tied to the debt trajectory of one government. And in a world where fiscal pressure is rising and policy flexibility is shrinking, that characteristic becomes more important. That is also why central bank buying matters so much. When sovereign institutions continue accumulating gold, they are not necessarily making an apocalyptic call on the dollar. The dollar is still dominant. It remains central to global trade, collateral, reserves, and funding markets. That has not changed. But dominant does not mean untouchable. Central banks do not need to believe the dollar system is ending in order to want more protection outside it. They only need to recognize three things. Debt burdens are rising, inflation is proving harder to fully eliminate, and long-term purchasing power protection matters more in that kind of world. That is the deeper mechanism beneath the gold story. Gold is not simply reacting to nominal yields, it is competing with inflation-adjusted returns and with trust in the policy regime itself. If real yields stay high and credible, that can limit gold. But if inflation stays sticky, fiscal stress keeps rising, and the market starts to believe policymakers will tolerate somewhat above-target inflation rather than impose the pain required to force it all the way back down, then gold starts to compete with cash very differently. And that is a major shift. Because the question is no longer just what pays income, the question becomes what protects real purchasing power in a system that is becoming less stable, less flexible, and more politically constrained. That is where most surface-level commentary falls short. It treats this as a simple inflation trade or a simple Fed trade. It is neither. It is really a credibility trade, fiscal credibility, monetary credibility, and investor confidence in the idea that the system can still be stabilized the way it was in the last cycle. Markets can live with high debt for a long time. What they struggle with is rising debt, rising interest costs, and no believable path to stabilize either one. That is when nominal assets begin to feel less safe than they look. And once that shift begins, repricing can happen much faster than expected. History never repeats cleanly, but it does rhyme around debt, inflation, liquidity, and trust. Confidence holds longer than people think. Pressure builds quietly underneath. Then suddenly the market stops giving policymakers the benefit of the doubt. That is the sequence to watch. And there is another layer here that matters. If institutional demand for gold broadens further, including through channels like China's Insurer Gold program, the story becomes even more important. Not because it ends the dollar system, but because it brings a new class of structural buyers into an already strategic market. And when demand broadens under the surface, price can move faster than the headline narrative catches up. So what should investors actually watch now? Watch real interest rates, watch deficits, watch Treasury interest expense, watch central bank gold purchases, watch whether inflation continues drifting lower or gets stuck above target. And above all, watch the Fed's language for one key signal. Is it gaining room to cut or losing room to maneuver? Because that is the real question. Can inflation fall enough to restore genuine policy flexibility? Or are we moving into a world where debt remains too large, inflation remains too sticky, growth remains too soft, and the Fed is trapped between supporting the economy and defending purchasing power? That is the puzzle markets are starting to confront. And the strategic takeaway is simple: the dollar is still dominant. But in a debt-heavy, inflation-prone system, nominal stability is not the same thing as real safety. Gold is not a magic trade. It is not a guaranteed answer. But when debt rises, policy flexibility shrinks, and cash quietly loses purchasing power, gold starts to matter for a very practical reason. It can help protect real wealth when the system has fewer clean answers. This is not a doom story. It is a balance sheet story. It is a credibility story, and above all, it is a math problem.